Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, January 13, 2015. You're looking at a daily chart of the SPY, and it was a wild day. So today is also known during options expiration week as Turnaround Tuesday, and boy did we have a Turnaround Tuesday. So if you go back to last night's video, I told you that my expectation for today was for the market to go up, and I talked about the E-mini contract because that's where I calculate most of my numbers from, and then I translate it for you guys into the SPY or the S&P 500. But what I said was that the E-mini was going to go to about 2031 and then 2040. And we actually went all the way up to 2051, but that was right out of the chute. So let's just look at an intraday chart and we'll see what happened. The market gapped up and it went right to the number. It went all the way up to 1251, a little bit higher than I had anticipated. And then we collapsed the rest of the day until we had a little end of the day buy program. What does that mean? It doesn't mean anything because here's the deal. During options expiration week, I told you this yesterday and I tell you each and every month that the institutions whip the market around at will. They're the ones that are going to take the market up and they're going to take the market down. They're going to take stocks up and they're going to take them down. They're going to wipe out the option players on the puts and the calls on either side so that they can collect the premium and that the retail investor or the inexperienced investor wants to close out their position before they lose all their money, and then they whip the market up the other way or down the other way, and that's exactly what they did today. They took it up, then they took it down. So you shouldn't read too much into this kind of action during options expiration week. Let's go back to the daily chart, okay? But here's the deal, okay? Here's what we have now. Right now, you have a trend line forming, and I'm going to see if I can draw this in for you. If you take this line, it always happens like that. Line, remove line. Let me try it one more time. I really don't like this charting software for this reason. Okay, so here's what you have. Now, what I think is going to happen is I think this line is going to wind up being important. Remember I told you if you break this low and this low, you either will stop at the 200 period moving average or you will go to this gap window here, which is right here, or this gap fill, or somewhere in between, and that would mark most likely a low in the market. Now, when will that happen? Well, I don't know exactly when that'll happen, but in my estimation, it should happen within the month of January, if not within the next, let's say, 5 to 7 trading days. Now, if we come and break this low, because I don't draw the trend lines, right? The market draws the trend line. The market just drew this line by the fact that this was a low, a higher low, and if we come down here and bounce up off of this trend line that I just drew and go higher, then that would have been or deemed formidable, okay? I didn't draw the line, the market drew the line, okay? But what I think will happen is if we come down and we break down below this low and or below this low, I'm not so sure that the 200 period moving average is going to hold, and I think we go down to this area. But I don't know that that's going to happen, but what I do know is that the month of January is winding up, or it is already becoming volatile. And, you have a lot of talk about oil. You have a lot of talk about Russia. You have a lot of talk about all kinds of stuff around the world. And you're just seeing a lot of both bullish and bearish sentiment fighting each other right now. And that really started at the end of December, and it hasn't subsided since. So what we have to do is we have to play it one day at a time. What do I think is going to happen tomorrow? Frankly, I don't know. Like today, I told you yesterday, today I thought the market would go up and hit those numbers, and it did, but then it rolled right over and collapsed the rest of the day. So to me, that was a little abnormal, and to me, that shows weakness, and I wouldn't be surprised if we come down and break this low, and we come either into the 200 or all the way down here. So we're going to watch it one day at a time, and if you start to break this line with volume, then I think that you're coming down to this area, let's call it between somewhere in the 190 to 191 and a half neighborhood, okay, on the SPY. And that's a little bit of ways down, but first you have to get through this area, and 199, 200 on the SPY is going to prove formidable resistance, because you're going to have a lot of bulls, a lot of buy the dippers look at that as a big round number, and they're going to look to buy that number. So we'll see what happens, but you have to understand that this week being options expiration week, kind of some of the normal consistent market performance gets thrown out the window, and during options expiration week, anything kind of goes. So we'll see what happens, and we'll play it one day at a time, and I'll just do the best I can to tell you what I think, what I see happening, and we'll take it one day at a time. Remember, we don't impose our will on the market. We let the market tell us what to do. And right now, the market's telling us that it's not sure exactly which direction it's going to go. So we're not in the business of guessing which direction the market's going to go. That's like a gambler's mentality. That's like saying, well, I think the dealer has a 10 underneath, therefore I'm going to hit. Well, you don't know what the dealer has underneath. I'm talking about blackjack. You're just guessing and you're hoping. What we do here is not based on hope. It's not based on guess. It's based on probabilities. And we only take trades when the probabilities are in our favor. And right now, there's no probabilities in our favor that the market's going to go up or down, at least going into tomorrow. So right now, we're going to play it by ear. We're going to see where the market takes us, and we take it one day at a time. Okay, let's move on. Oh, by the way, let me just mention my favorite indicator, IWM. What would be a night without me mentioning IWM? Now, IWM finished positive today, albeit not that much, but it still finished positive. And remember yesterday I said IWM was stronger than the S&P, and that was one of my indicators that the S&P was going to go higher early today, and it did. Not to say it's going to happen again, but the IWM finished positive today, and the S&P finished negative. So to me, that is an indicator. It doesn't tell me much. It just tells me that there is a bid underneath this market. So I just wanted to make mention about the IWM. That's the small cap Russell 2000 index, small business in America. Very important. All right, let's move on to crude oil. And I really don't have much to add to crude oil because nothing happened, right? Crude oil is still headed down. We still don't have a definitive low. We have no reversal day. You had a little bit of higher volume today. And, while you did kind of finish, you finished positive on the USO. Where is crude oil? Crude oil in the aftermarket session is at 46.14. It's up a little bit, but that's meaningless. That doesn't mean anything, okay? We're in the mid-40s, and I said all along, I was telling you 48 was my number, and once we broke 48, then I'm saying 42.5 to 43.5 is my next target. And until we get there, and if we get there and we show signs of a bottom, meaning we have high volume, we have a reversal day, you go down, you reverse up on high volume, finish at the highs of the day, that to me is a bona fide reversal day, but that's not what we have here. We didn't have it today. There's no reversal going on. So until further notice, crude can go lower. Remember, I said this last night, and I always say this, markets can go a lot lower than we anticipate, and they also can go a lot higher than we anticipate. So right now, we're in one of those scenarios where crude oil is going lower than a lot of people ever had anticipated it going. So here we are. It's still weak. And every time the market goes down, crude oil gets blamed for the market going down. That's nonsense. Let the talking heads have their way. It doesn't make any difference. We're looking for a reversal day in oil, and until we see a reversal day in oil, there's no energy stocks that you want to buy because they're all going to be weak pending oil's reversal. So just keep that in mind. All right, let's go over to a different market in gold, and this one's going to be a little bit more fun than oil. Why? Because I've been telling you for several days, if not a week and a half or so, that during the month of January, 1240 to 1245 was going to be the number or higher. Guess what? The high today was, I have it written down here, where was it? 1244.50, okay? 50 cents off my 1245. That's 1240 to 1245. That's a bullseye, okay? I do think gold can still move higher, but I think now you may pause for a while because remember I said that this pivot here was going to be formidable resistance, right? This level here, this is the GLD at 118.99, call it 119, it's close enough. Okay, I said this was going to be formidable resistance. We pierced through it today and then reversed a little bit. So it's down a few bucks in the aftermarket in the Globex session, but I would look for a pullback for a few days in gold. And then based on the type of pattern it puts in, I think that there's going to be more bullish upside to be had. So I would look for maybe a couple of 3, 4, 5 days of downside like this, and then I would look for that good pattern, another higher low, right? We had a low, higher low, higher low, higher low. This one was equal, and then we went off to the races. We hit that number, 1240 to 1245. Now let's pull back a little bit and let's get another thrust forward, and we'll play that thrust forward. But right now, I'm out of gold based on the 1245 or 1244.50 being hit. That hit my target, bullseye. You gotta love that. Hopefully, folks took advantage of that call way down here when I was saying accumulate gold, 1240 to 1245 within the month of January was the number. Turned out to be true. I love when a plan comes together. All right, the last thing I'm going to talk about tonight is interest rates again. And let's go over to the TLT for a second, which is the 20 to 30-year ETF that tracks the bond market or the treasury bond market. And you're still in a bullish configuration here. I mean, look at the weekly chart, right? Let's just go over and check this out. I mean, this is a parabolic move, but remember what I said. What I say is that this 20-period moving average, which is the red line, normally markets like to stay close to home. Look how often, we go away from the 20-period, we move closer. We hug the 20-period, not too far away, back to the 20. We hug the 20, a little bit far away, back to the 20, back to the 20. Okay, up here, back to the 20. Here we go. We're going to come back to the 20. It's just a matter of when. But what's more important is, let me go to the interest rates, because that tells the tale. I'm going to go to the 10-year interest rate, okay? Look where we are, 189 on the 10-year interest rate. That means that if you want to loan the government money, safe money, and get a return based on a treasury bond, you're going to buy treasury bonds, meaning you're loaning the government money. They're going to give you 1.89% return for 10 years. That's nonsense. That's ridiculous. What that's telling you is, look, we're coming into a double bottom here from this capitulation low. Okay, that's probably going to be formidable, and it's probably going to bounce off that level. But what this is telling you is that the stock market has trouble. And the reason I say that is because the bond market is A, a lot bigger than the stock market, and B, the bond market participants are a lot smarter than the stock market participants. Most of the stock market participants are typically gamblers. Most of the bond market participants are there for safe money. They know what they're doing. They buy bonds because they know that they're going to get their money back, and they're going to get a specified rate of return while they hold a bond. Okay, they're different types of people. It's different buckets of money that plays the bond market versus the stock market. It's more risky assets versus less risky assets. The bond market is less risky assets. Right now, the bond market is telling you that money is headed into the bond market because it's going away from the stock market, okay? That's why rates are so low. That's one of the reasons why I tell you that I don't think the market's finished going down yet. And if we just go back to the SPY for a second, all right, bear with me here. If we go back to the SPY for a second, this is weekly. Let me go back to the daily. That's why I think that this choppiness action, okay, is not, why can't I move the chart? Is not over yet. And that's why I think we're going to come at least down to this trend line that the market is drawing for us, or this 20-period moving average, or worst case, down in this gap window, gap fill area. And if we get down here, you'll see me call a buy signal on this market. But this is a long way down, okay? This is going to be another 100 points in the S&P. 100 points down from here in the S&P is going to scare the heck out of people, and it's going to cause all the bear suits to come on. It's going to cause the bulls to go into hibernation and the bears to come out of hibernation. And just when the sentiment gets bearish enough, we're going to be there to pick up the pieces, and when nobody wants the market, we're going to be there to buy it, okay? I think that's about all for tonight. Hopefully this has been helpful. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.